If you've ever done business across borders, you know that feeling, right? Money can feel like it's changing value right before your very eyes. Well, today, we're going to break down foreign currency accounting by following a single $1,000 invoice from start to finish. We'll see exactly how those gains and losses pop up on the books.
Okay, so before we dive into the numbers, let's get on the same page with the core concept, the foreign exchange gain or loss. Simply put, it's just the difference in value that happens because the exchange rate moves around between the day you send an invoice and the day you actually get paid. Your books have to account for that change.
Here's how we're going to tackle this. First, we'll look at the initial invoice. Then we'll see how a rate change can create a loss, at least on paper. After that, we'll watch the rate swing back, creating a real gain. And finally, we'll tie it all together. By the end, you'll see how it all clicks into place.
Okay, let's jump right in. Our story starts with a pretty standard invoice that we're sending out to a client. The invoice is for a nice round $1,000. Now this amount is our anchor. It's the fixed number that our client has to pay us. No more, no less.
So here's where it gets really interesting. We have to record this thing in two different currencies. The easiest way to think about this is like you have a USD wallet and a local wallet. In our case, that's Malaysian ringgit or MYR. On day one, the rate is 5-to-1, so our $1,000 invoice gets booked as a 5,000 MYR sale. At this moment, everything is perfectly balanced.
But, things in the currency world rarely stay balanced for long. Let's fast forward to day 2. Our client makes a partial payment, and this is exactly where the market starts to flex its muscles.
And yikes, you can see the rate has dropped. It went from 5.00 all the way down to 450. Now this isn't great news for us. It means every single US dollar we receive is now worth less in our local currency.
So the client pays the first $500. Now in our USD wallet, that's super simple. We got half the money. But what does that look like in our MYR wallet?
Well, because the rate went down, that $500 is only worth 2,250 MYR now, not the 2,500 we originally had on the books. And this is the absolute key. To keep everything balanced, the accounting system automatically creates a Forex loss entry to make up for that 250 MYR difference. And that right there is a perfect example of a paper loss. It's not like we physically lost cash, but it's a critical accounting move to make sure our local books are showing the true current value of the money we received.
But hey, the market is always moving. Let's jump ahead to day 3. The client is ready to pay off the rest of the invoice, and this time, the market has decided to be our friend.
And it's a pretty big swing back. The rate has leaped from 4.50 all the way up to 5.50. Now we're talking. Each US dollar is now worth a whole lot more in our local currency.
The final $500 comes through. Our USD wallet is now full, invoice paid, but let's see what this lucky break does for our MYR wallet.
Now check this out. That final $500 payment at the new, higher rate is worth 2,750 MYR. That's 250 MYR more than what was left on the books. So to balance everything out, the system does its magic again and automatically generates a Forex exchange gain. And just like that, the 250 MYR paper loss we took on day 2 is totally wiped out by the 250 MYR gain on day 3. This is the heart of Forex accounting, really. The books are constantly adjusting to the real-world value of that money.
So, after that little roller coaster ride with the exchange rates, what do the final records actually look like? Let's pull up the final ledgers and see how it all nets out. First, let's look at our USD wallet. And yeah, this is as clean and simple as it gets. We sent an invoice for 1,000, we received 2 payments of 500, and the final balance is 0. Done and done. But the MYR ledger? Now this is where you see the whole journey. You can literally trace the initial 5,000 MYR value, see the first payment and that loss adjustment, then the second, more valuable payment and the gain adjustment. And the final balance? You guessed it, a perfect 0.
So what did we learn here? The big takeaway is that the amount in the foreign currency, the $1,000, that was fixed, but its value in our local currency was always moving. Smart accounting systems handle this by automatically creating those gain and loss entries to keep up. And it all leads to the final settlement, where the books in both currencies can finally be balanced to 0.
And that kind of brings us to the bigger picture, doesn't it? For our one little invoice, the gain and loss conveniently canceled each other out. But just imagine a global company that's processing thousands of these transactions every single year.
All of a sudden, these tiny daily fluctuations can add up to huge numbers, and it shows you exactly why managing foreign exchange risk isn't just some boring accounting task. It's an absolutely critical business strategy.